The day before the Chancellor's statement, the Bank of England raised interest rates by 0.5 percentage points to 2.25%. The bank has raised rates at each of its last 7 meetings since December 2021 as it tries to lower inflation back to the 2% target. Now, what's interesting is the Bank of England were the only bank in the world conducting a very strange tightrope walking policy of quantitative tightening and selling off bonds. Because they conducted quantitative easing, mass printed money to pay for the furlough schemes that Rishi Sunak had instituted during COVID. And so what they did is they sold off government bonds to give themselves less fiscal headroom, but also raised interest rates to try and control the money supply. So that means the gap of maneuverability for governments to use their budget narrows. And so it means that if there's any discrepancy in the calculations, you essentially engineer yourself a crisis. There's more on this here from the New York Times reporting at the time. It says, the Bank of England raised its key rate, which is of course interest, another half a percentage point on Thursday to 2.25%, taking it to the highest level since late 2008 when there was a market crash. But disappointing some who thought it would make a 3/4 point move. In Britain, consumer prices rose 9.9% in August from a year earlier, slowing slightly from the previous month, but still near the fastest pace of inflation in 4 decades as energy and food prices climb higher. What does all this tell you? Equivalent market rate to 2008. Consumer prices rose 9.9% in August, so inflation's still going up at nearly 10%. Was Liz Truss in power during any of this time? The Bank of England acts wholly independently from the Treasury, and so she couldn't prevent them from putting interest rates up. They did it the night before the mini-budget to a rate that was comparable to the last time we had an economic crash. Do you think that this didn't have any effect on the markets? That Liz Truss's announcement that wasn't even passed as an act of parliament had more impact on the markets than this quite drastic move? I also got a note from a source on this. It said, it's worth mentioning that the Bank of England's interest rate rise the night before the mini-budget was less than expected and less than the federal markets that various countries, particularly the United States, liked. Which means that there is an international consensus about how finances should run that weren't being adhered to here. And so there was friction between Liz Truss and the Bank of England and other global markets. So you've got this sort of domino chain of financial instability that all hits around the time of when the mini-budget is put in place. And it just so happens that Liz Truss rubbed those various establishments up the wrong way with her increasingly obstinate unwillingness to accept certain woke shibboleths. Now, Truss claims she wasn't informed of this. Neither was Causey. And that it coincided with the fire sale of gilts government bonds. And here's a report that suggests actually she's telling the truth. Now, this was from earlier this year. This was from, I believe, August. 24th of August, 2024. So the working paper from the Bank of England, written by 5 members of bank staff and published in May, but broken down by the Telegraph in August, studied risks which built up in the long period of very low interest rates following the 2008 financial crisis, as funds hedged against the threats to their solvency. They found that dangers mounted as institutions were not, quote, were not particularly sophisticated at managing their liquidity risk, set up positions which were vulnerable to sharp interest rates rises. For example, rising interest rates at considerable rates to that in 2008, when the last financial crash happened, on the night before a financial mini-budget. The analysis called this lash risk, short for liquidity after solvency hedging. This occurred, quote, well in advance of the onset of the crisis before the election of Liz Truss as Prime Minister, according to the report by the Bank of England. There's an interesting graph in here that they put. So if you see here, this is September 2022. These are the 10 and 30-year gilts, the length of the government bonds. The 23rd of September is the mini-budget, right? So they've been sort of steadily rising. They go up to coincide with the mini-budget. They then go up again after the 26th of September, much more steeply, and on the 28th of September. This is all entirely independent from the mini-budget. This is what the Bank of England is doing. And they've admitted in their own reports that this was more important a factor in the pound being weakened against the dollar and all of the international markets freaking out. The analysts concluded at the Bank of England that 0.66%, almost 2/3 of the 1.03% jump in 30-year borrowing costs was caused by their lash-induced trading. 2/3 of the market panic was caused by the Bank of England, in their own words. So Truss saying, well, how could my mini-budget have caused this market run, is completely vindicated by the architects of the market crash and her downfall. Look at this visual representation. It's absolutely undeniable. If this hasn't convinced you yet, there's more data in here. The Bank of England began raising rates in December 2021, so almost a full year before Liz Truss was Prime Minister. And the market rates jumped again with the mini-budget in September 2022, but it was done just before it. Funds were forced to sell off bonds to free up cash, worsening the jump in government borrowing costs and setting up a vicious spiral which was only diffused when the bank launched an emergency program to buy bonds and stop prices plunging. The borrowing costs meant that the government couldn't appeal to international institutions because they had a bad reputation to borrow themselves out of a hole. But part of this is, of course, that if Liz wasn't adopting the social values of those institutions, they wouldn't lend to her. So you needed people in place like Hunt and Sunak who would do everything that the international institutions like the United Nations wanted in order to secure those funds to bail them out when they'd spent too much money on exactly those social programs that none of us, including Liz, wanted. Quote, "The abrupt change in the fiscal stance initiated a sharp downward adjustment in government bond prices, which was amplified by the vulnerabilities, lash risk, in the pension fund and LDI, which are liability-driven investment sectors. This is according to the Bank of England." Now, a previous report from the Bank of England had only blamed the mini-budget for half. So this is getting progressively more on the bank. The bank are increasingly going, yeah, we might have messed up more than we originally said. So as time rolls on, Liz is less responsible for this crisis than was first laid out. The Bank of England researchers found that the selling of risky products, these are the LDIs, liability-driven investments, by pension funds, in the wake of the mini-budget, was equally responsible for the rise in bond yields. So with that previous diagram, on the 26th and 28th, they themselves made it worse by their reaction to what they thought was, or at least what they said was, the mini-budget causing a mass run on gilt prices. But they'd put up the interest rates, the gilt spiked. Then they blamed the mini-budget, so they sold and sold again, and they keep spiking. So the Bank of England's own monetary policy is responsible for the majority of the problem here. And they've admitted it, and they've revised it up from being half the problem to 2/3 of the problem. But back when they said it was half, they said that, at the time, of course, commentators blamed the surge on international investors balking at Liz Truss's plans to borrow at the same time as cutting taxes. But the analysts have found that the crisis was made at least twice as bad by pension funds that were forced into a fire sale of assets. The problem was caused by LDIs. And this is a product the pension funds have poured money into. LDIs used borrowed money to buy gilts, UK government bonds. Borrowing costs jumped, so then LDIs were sold back. LDIs sold their gilts to reduce the risk. This fueled the meltdown and drove up borrowing costs. So this is where you get the vicious circle from. Quote, this is according to the report, "LDIs sold gilts to reduce leverage after the announcement of the mini-budget, resulting in large fire sale discounts in the gilt market." And this was published on the Bank of England's own blog. So they are, again, admitting fault here. It's just far too late to, for many cases, other than if Liz or people like us can get the word out, save her reputation and allow subsequent governments to start putting more money back in our pocket and stop spending money on wasteful wars, wokery, and foreign criminals residing indefinitely in this country. Quote, "LDI selling accounted for at least half of the fall in gilt prices during the crisis, with fiscal policy likely accounting for the remainder." The report was written by Danny Walker at the Bank of England, Gabor Pinter at the Bank for International Settlements, and Emil Sirwandane, professor at Harvard Business School. So the typical types that would be pro-ESG, pro-Keynesian economics, and even they're saying, yeah, the Bank of England did mishandle this. So, okay, it's at least half to 2/3 not Liz's fault. That's the majority. So how can we blame the mini-budget for the financial crash? Was it actually a problem, or did they just want her out of the way? Another report from the Treasury in February rebuked the Bank of England for reckless behaviour. So here's the report. It's titled, "Bank of England has taken a leap in the dark on quantitative tightening. Treasury Committee concludes." I mean, you can't really get much more damning language. The Treasury Committee determines the bank has embarked upon a major monetary operation on which experts are divided regarding the risks and appropriate pace of implementation. This constitutes a leap in the dark, the committee affirms, as the bank continues to progress work despite uncertainty over quantitative tightening's wider effects, the selling off of gilt. One area of higher uncertainty relates to the potential overall losses which may be incurred by quantitative easing and quantitative tightening, mass money printing and selling off gilts. It was estimated that between 50 billion and 130 billion could be lost through the lifetime of their programs, with potentially significant impacts for Her Majesty's Treasury spending power for the next decade. They've lost possibly 130 billion quid And yet Andrew Bailey stays as governor of the Bank of England and cannot be removed by the Prime Minister. But the banks can remove Liz Truss over this? This just doesn't seem right. If the governments are admitting the banks may have lost the country £130 billion through money printing and selling off bonds recklessly, why are any of these people still in the job, and why is Liz Truss out? You've got to ask yourself this question. It's very confusing. It doesn't jibe with conventional wisdom. They say in here, the Bank of England's Monetary Policy Committee, the MPC, their initial vote to launch active quantitative tightening was published on the 22nd of September 2022, just prior to the announcement of the mini-budget on the 23rd of September. An exceptionally sharp rise in gilt yields on that day and the following few working days, and the outbreak of the financial crisis related to the liability-driven investment strategies of defined benefit pension funds. So, pension fund collapse, which had been building for a while, mass interest rates hiked, considerable comparable to the 2008 financial crash, and a sell-off of gilts over the next few days impacted the financial markets far more than Liz Truss announcing a 1% income tax cut, and that she wasn't going to raise taxes further as was originally planned. Which, the raising of taxes would necessitate more spending, but not servicing the debt, so that means that debt would continue to accumulate. So if she was being accused of irresponsible borrowing, well, the borrowing would have, and also did happen under Hunt and Sunak anyway. And yet, nobody bats an eyelid. Very curious. Despite all this, the report says, quote, "We did not receive substantial evidence that quantitative tightening had been a causal factor in the outbreak of the LDI crisis." So hold on. Again, the Bank of England loses a potential £130 billion. We've got all the data there that shows from the Bank of England themselves that they were responsible for half to 2/3 of the market crisis. This was published before and after this report came out. Mass money printing has driven inflation because the economy is supply and demand, and so if you have a greater money supply than a greater supply of goods, and the demand for goods stays the same, then goods cost more money. And yet you can't draw a conclusion that would indict the Bank of England in such a fashion? Why are they protecting each other? Is Liz Truss the scapegoat for this? Why hasn't Andrew Bailey lost his job? Thanks to the independence granted to the Bank of England by Gordon Brown. So this is why, after all of this happened, after this mass run on gilt markets, the interest rate rises, this is why Liz Truss resigned. And a few days after Liz Truss resigned, this was written in Bloomberg on the 26th of October 2022. Markets didn't oust Liz Truss, the Bank of England did. And it reads in here, over the 3 days starting September the 23rd, when the Truss government announced its mini-budget, the pound fell by 2.2% relative to the euro, and the FTSE 100 stock index declined by 2.2%. Notable movements, but hardly enough to bring a government to its knees. The big change came in the price of the 30-year government bonds, also known as gilts, which experienced a shocking 23% drop. But the mini-budget didn't affect gilts. It was the Bank of England that did that. Most of this decline had nothing to do with rational investors revising their belief about the UK's long-run prospects. Rather, it stemmed from financial regulators' failure to limit leverage in UK pension funds. These funds had bought long-term gilts with borrowed money and entered derivative contracts to the same effect, positions that generated huge collateral demands when prices fell and yields rose. To raise the necessary cash, they had to sell more gilts, creating a doom loop in which declining prices, forced selling, compounded one another. The Bank of England, as the entity responsible for overseeing the financial system, bears at least part of the blame for this catastrophe. As a result of its regulatory failure, it was forced into an emergency intervention, buying gilts to put a floor on prices, but it refused to extend its support beyond October the 14th, even though its purchases of long-term government bonds were fully identified by the Treasury. It's hard to see how that decision aligned with the central bank's financial stability mandate, and easy to see how it contributed to the government's demise. Basically, the Bank of England mismanaged the money supply, liability-driven investments, and interest rates. It all coincided with the mini-budget, and Liz Truss was blamed for it and ousted for it. And still to this day, is blamed for the crashing economy, which she had no knowledge nor hand in. Thank you for watching that clip from Tomlinson Talks. If you liked that and you would like to see more, you can get the full 90-minute show every week on a Wednesday afternoon, live from 3 p.m, only on lotuseaters.com, and all of the other content that my colleagues produce behind the paywall for as little as £5 a month. Thank you very much for supporting us, and I hope to see you there. Until next time, goodbye.